Hey everyone, welcome back to Corporate Decoder. Today, BKYI International Incorporated just filed its 2025 10, and I am seeing some serious red flags that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is facing delisting from Nasdaq and is struggling to make ends meet, which is a tough spot to be in. So, BKYI International Incorporated, which you might know by its stock ticker BKYI, just released its big annual report, the 10K. This report gives us a deep dive into their finances and what happened in 2025. And let me tell you, it paints a pretty challenging picture. One of the biggest pieces of news here is that trading of their common stock on the Nasdaq capital market was actually suspended in May 2026. This is a huge deal because it means the stock is no longer listed on a major exchange. They are appealing this decision, but historically, a lot of companies that go through this kind of reverse stock split and then face Nasdaq issues also end up delisted. Think about Kodak back in 2021 when they did a 1-for-20 reverse split. Their stock faced major drops after that. For BKYI, this suspension likely means their stock is now trading on the OTC markets, which are generally less regulated and have much lower trading volumes. This can make it really hard for investors to buy or sell shares without affecting the price, and it could severely impact their ability to raise money in the future. And speaking of share counts, as of the 10th of June 2026, they had about 1,085,360 shares of common stock out there. This number has been affected by a recent 1-for-10 reverse stock split that happened in April 2026. Reverse splits are often a sign a company is trying to boost its stock price to meet exchange requirements, but they themselves don't fix the underlying business problems. Back in June 2025, the market value of the shares not held by company insiders was around $4.9 million. This tells us the company's overall value as seen by the market is quite small, which makes sense given the challenges they are facing. Now, let's talk about the money. In 2025, their total revenue was nearly $6 million. That might sound okay, but it is actually a decrease of about 14% compared to the previous year, 2024. This drop to just under $6 million is partly due to losing a big contract with a foreign bank and a shift in how they sell products in Europe, the Middle East, and Africa. A big part of that revenue drop came from license fees. They saw a 34% decrease here, going down to about $3.4 million. Again, this is tied to that big bank contract not coming back and their strategy change in the MEA region. On a brighter note, hardware sales actually jumped by a huge 112%, reaching about $1.3 million. This increase was due to long-term customers expanding their purchases and selling off some old inventory that was set aside for projects in Africa. Following these revenue changes, their gross profit, which is the money left after paying for the cost of making their products, went down to about $4.5 million in 2025, from nearly $5.7 million in 2024. This is because they had lower license fee income and increased sales of hardware and services that generally make less profit. But here is where things get really concerning. While revenue went down, their total operating expenses actually went up, reaching over $11 million in 2025 compared to about $9.6 million in 2024. This means they spent more money than they brought in. This big increase in expenses combined with lower revenue led to a much larger operating loss in 2025. Their operating loss was almost $6.8 million, which is a significant jump from the nearly $4 million loss in 2024. Adding to the financial pain, they recorded a massive $2.5 million charge for an impairment of investment in 2025. This means they had to write down the value of an investment because it is not worth as much as they thought. The filing states this is a 50% write down on an investment based on expected revenue that has not happened yet. This ties into their investment in Boomerang Incorporated, a drone technology company. When you combine all of this, the company ended up with a net loss of over $7.1 million in 2025. That is a big jump from the $4.3 million loss in 2024. It really shows how much money they are losing. And this brings us to a critical point that the auditors highlighted. They included a paragraph in their report stating there is substantial doubt about the company's ability to continue as a going concern. This is a very serious warning. It means that based on their current financial situation, including their history of losses and their reliance on external funding, there is a real question whether the company can stay in business for the next year. Think about companies like Bed Bath & Beyond or Rite Aid. They face similar warnings before going bankrupt. For BKYI, this going concern warning is a direct result of their high cash burn and dependence on outside money. The company acknowledges this by saying they've always relied on selling stocks and debt to keep things running. They need about $750,000 a month just to operate, but in 2025, they only brought in about $5.9 million in revenue, which wasn't enough to cover their costs. To stay afloat, they raised about $8 million through financing activities in 2025, so they are constantly looking for new money. This came from things like issuing notes, exercising warrants where investors buy more shares and selling some stock. They do talk about cybersecurity, which is important in their industry. They have a structured approach with a steering committee and a cybersecurity engineer. They mention keeping up with threats and evaluating new service providers. They understand the risks, but the big question is whether their plans are enough to overcome their financial struggles. In their risk factors section, they clearly identify serious threats like nation-state hackers and ransomware. They understand the potential damage from intellectual property theft or data breaches. While they have processes in place, they also admit they might not be successful in preventing a major cybersecurity incident. They are classified as a non-accelerated filer and a smaller reporting company. This means they are under less stringent SE reporting requirements, which is common for smaller companies, but it also highlights their size given the financial challenges. So, you've got a company that has lost money for a long time, has serious cash needs, and is now facing suspension from a major stock exchange. They are trying to do things like reverse stock splits and new financing to keep going, but the core business is bleeding cash. My biggest concern is definitely the going concern warning. It is a direct signal that the business itself is at risk. What I am actually looking for is to see if they can genuinely turn around their revenue generation, or if they will continue to rely on dilutive financing and asset sales to survive. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this breakdown helpful, please give it a like and subscribe for more. Join our Discord in the description for more discussions.